So what is up YouTube? In today's video, I'm going to be talking about 4 stocks, 3 of which are high growth stocks and another one has the potential to become a high growth stock. And I won't be going too much into the business model or financials as I will be making a separate video on each one of these stocks. However, I will be giving a basic idea of why I'm buying these stocks. So the first stock is CrowdStrike Holdings, which is trading under the ticker symbol CRWD. So what does CrowdStrike Holdings actually do? So CrowdStrike Holdings is a cybersecurity expert and it offers its enterprise clients its threat monitoring Falcon platform. CrowdStrike can detect attacks before they strike critical IT infrastructure, and it can then warn its entire client base to help defend against similar attacks in the future. And CrowdStrike Holdings was actually specifically made for cloud. So why do I like CrowdStrike Holdings business? One reason is that the other cybersecurity products out there aren't as effective as CrowdStrike's Falcon. Another reason why I like this company is that as technology improves and IT infrastructure improves, there will be more cyber attacks, and that will lead to more demand in cybersecurity, which CrowdStrike is a leader in. Another reason why I like this company a lot is because more companies are transitioning into cloud, and CrowdStrike Holdings is one of the only companies that offers cybersecurity for cloud. And cloud computing is bound to grow as the market is expected to become $832 billion by 2025. So as cloud computing becomes more common, CrowdStrike Holdings revenue will grow a lot faster. So now let's talk about CrowdStrike Holdings financials and valuation. So CrowdStrike Holdings is currently trading at $144 with a market cap of $31.75 billion. Now let's look at the revenue growth. So in 2017, CrowdStrike Holdings revenue was $52 million. In 2018, it was $118 million. In 2019, it was $250 million. And in 2020, it was $481 million. So they've been close to doubling their revenue every single year for the past 4 years. And in 2021, they're estimated to do anywhere from $761 million to $850 million, which is 70+% growth. And in 2022, they're estimated to do anywhere from $1 billion in revenue to $1.29 billion in revenue, which is 40+% growth. And in terms of earnings, they're burning a lot of cash, and they've actually used around $141 million in 2020. However, they've been destroying earnings expectations over the past couple quarters. Like they had a 400% beat once. So I think right now they're not aiming towards profitability as there's such a big opportunity with cloud computing. However, in 2022 or 23, they might start becoming closer or will become profitable. And their balance sheet is decent as they have $1 billion in cash and 0 in debt as of Q1 2021. So now let's talk about their valuation. So the price to sales ratio is 48.52 and their forward PE is 578.64, which is actually really high for any company. However, it does kind of make sense with their revenue growth and their projections. However, there is still a risk whenever you're investing in valuations like the one CrowdStrike Holdings has. So what my plan is to just enter into the company at $140 just to get a position in the company. However, in corrections, high growth stocks like CrowdStrike Holdings get destroyed. And an example of that is in March when the stock went as low as $40. So my hope is I'll start to add quite heavily once it reaches the 120 or even lower than that. And if it doesn't, that's fine with me too, especially if it can actually hit on the forecast and execute the huge opportunity it has in the coming years. The second high growth stock that I will buy is Teladoc Health. Teladoc Health's business model was suited perfectly for the pandemic as they provide virtual healthcare services on a business-to-business basis in the United States and internationally. So the pandemic was actually a catalyst for Teladoc Health. However, I think the company will continue to grow even though it won't grow as fast because rather than going out and driving somewhere, they could just use Teladoc Health's product. And Teladoc Health will also be acquiring Livongo Health at the end of 2020. And Livongo Health provides an integrated suite of solutions for the healthcare industry in North America. The company offers a platform that provides cellular connected devices, supplies, informed coaching, and data science-enabled insights. Their products include Livongo for diabetes, Livongo for hypertension, Livongo for prediabetes, and weight management. The merger will combine Teladoc's focus on providing a broad range of virtual care services with Livongo's highly personalized data-driven approach to health signaling. And Teledoc's market is 70 million customers in the United States and is a strong platform for Livongo to reach new customers at risk of living with a chronic disease. And this company, as of 2019, has done revenue of $553 million. However, they're forecasted to do around $990 million in revenue in 2020, which is 79% increase. And the company is still burning a lot of cash. And when we talk about valuation, the company has a price to sales ratio of 25.91 as their market cap is $18.8 billion. But I still think this company is a buy, as I think Telehealth is just getting started, and I think the merger with Livongo will push Teladoc a lot further. The third high growth stock that I'm going to be talking about today is Slack Technologies. So what does Slack Technologies do? Well, Slack Technologies offers a collaboration platform that combines the power of instant messaging, telecommunications, and file sharing to make workplace interaction more efficient and productive. So it's basically like emails for businesses. Yet it offers a lot more. So one reason I like this business a lot is a lot of businesses have already started using Slack, and there is a free version, already a lot of users. So if more convert into paid users, then revenue will grow tremendously over the coming years. And this company believes its total addressable market is around $28 billion. And right now the company is only doing $500 million in revenue. So that means it has plenty of room to grow. However, that doesn't mean they could take on the whole market, because there is some competition in this industry, and one notable competitor is actually Microsoft with Microsoft Teams. And that's my major concern with this business, is that a lot of people say Microsoft Teams is actually better than Slack technology. So it's not like Slack has a much better application, but they are very similar. It's mostly just preference. So when we talk about the revenue, they did revenue of around $400 million in 2019 and $630 million in 2020, and they're expected to do around $850 million in 2021, which is around 40% growth. However, this company continues to burn tons of cash, as in 2020 they were negative $571 million. When talking about valuation, this company has an $18.5 billion market cap, and it's not expected to be profitable anytime soon, and they have a 24 price to sales ratio. So is it worth buying the stock? Well, I think I'm going to be entering into it now, as it has tons of potential with a $25 billion addressable market. However, in corrections, the stock usually tends to drop 30+%, and these are for all three stocks. If the market dips around 15%, these stocks dip a lot more because they are high growth stock and they are extremely volatile in times of uncertainty. So now let me talk about the fourth stock that I'm going to buy that I think has potential to be a great growth stock in the coming years. So what does Workhorse do? Well, Workhorse is a technology company that designs, manufactures, builds, and sells battery electric vehicles and aircraft in the United States. The company also develops cloud-based and real-time telematic performance monitoring systems that enable fleet operators to optimize energy and route efficiency. Its products are medium-duty trucks under the Workhorse brand. They basically manufacture electric delivery vehicles. And the reason I say this stock has the potential to become a great growth stock is because as of 2019, they only had $370,000 in revenue and negative $37 million in earnings, because they are spending a lot of money on research and development. But however, in 2020, they're expected to do $21.15 million in revenue, which is a 5,000% increase from the year before. And in 2021, they're expected to do $142 million in revenue, which is a 500% increase from the 2020 estimates. So now let's talk about Workhorse's valuation. So Workhorse's market cap is $2.5 billion, yet the revenue as of 2019 is only $350,000. This gives them a price to sales ratio of 8,700. So the valuation is insanely high, and hearing this, many investors will walk away, but you have to understand why the stock is being valued like this. First thing is, the stock is projected, or the company is projected to have 5,500% growth this year and 500+% next year. And they're also competing for a $6.5 billion United States Postal Service contract. However, the main risk for this company is that a lot of the growth is if they get the contract. So a lot of the growth projections are assuming Workhorse gets at least a part of the contract, and whether Workhorse did or didn't get the contract is still unknown. It was supposed to be announced a few days back, yet it got postponed to the end of the year. That's why the stock has been falling a ton. So at what prices am I going to buy this stock? Well, under $20 would be my price point, and if it falls under 15, that's where I'll be buying heavy. And the reason I like the stock so much is that it's in its own niche in the EV market, and not even that, it owns 10% of a company called Lordstown Motors, which is also in the electric vehicle truck market. So I think in both areas, Workhorse has tons of potential. Yeah, I think it's still the most risky stock out of the four. Now, this was just a brief explanation of the companies and why I'm buying into them. However, I will be doing a more in-depth analysis on each one of them in the coming weeks. I'll also be doing videos on SPAC stocks that I'm looking at and buying, and I will be doing a highly on stock update. So if you guys found this video helpful or you guys liked it, please consider leaving a like and subscribing. Also, comment down below what other videos you'd like to see, and thank you for watching.